Let's talk macro, beginning with the U.S. dollar with Mr. Jim Paulsen joining us, the Chief Investment Strategist at the Leuthold Group. Jim, I love the title of your recent note because it uses one of my favorite words in the English dictionary. It's dubious, the dubious dollar. What do you mean?
Well, maybe it's just my my experience with it, Oliver, but I've had a heck of a time over the years trying to predict the dollar. I think the stock market is much easier than the dollar. It's just seems to have a mind of its own, but you know, it's never stopped me. So I went ahead and still made a prediction nonetheless. But I wanted to make sure people understood that I'm not exactly super confident in it either. So.
All right, so the dubious dollar, it's been tricky. I'll tell you what, it's obviously not just you, Jim, because there's probably no more consensus view I can think of coming into this year that the downtrend in the dollar would resume uninterrupted. It has been quite interrupted now. We've made make it actually 3 higher highs on the dollar on the year and maybe a higher low. So what do you look at now as this trend? Is it just a brief hiatus from the downtrend, or do we have real reversal happening?
You know, I'm still with the consensus view that we're going to break lower yet this year, Oliver. The primary reason for that, from my perspective, is when I look back historically, whenever we've had global synchronized acceleration, it tends to benefit foreign economies more than it does the United States, particularly with any kind of inflationary overtones. If you think about it, the United States does the best in slow-growing economies because it has a lot more growth-oriented companies that can grow right through general cyclical weakness. Most of the rest of the world is not that way. They're still more cyclically related, and they need heat. So we're headed to heat right now in the world economy, and that's going to benefit the industrial, material, commodity-oriented makeup of foreign economies much more than the United States. And with a cyclical rebound that's synchronized across the globe, I think it's going to benefit foreign currencies much more than the United States. Also, the safe haven premium goes away from the dollar. In weak growth times, it tends to attract capital for safe haven purposes, but when growth gets good, just like other risk-on assets, you start to dump the dollar. So I still think the other thing that's interesting is on that DXY, if we do break below that 89 level, then there's a gap move technically down to about the 80 level. That could play havoc on a lot of situations later this year or next year if it breaks, particularly if we're already worried about inflationary pressure and interest rate pressure, because if the dollar would break lower, that put a lot of upward pressure on inflation, on rates, and on the Federal Reserve.
Love this point, Jim, and the technicals for the dollar agree are super interesting right now. In the short term, we're trying to see if that previous high will become support. One thing I've learned in the dollar the past year is you wait until proven on the technicals, especially when it comes to support for this thing. If we pull back and look at a 10-year chart, which we're going to pull up right now, to your point here, the dollar goes from 87.5, I'm looking at the index, down to basically 79 in that huge move. And the 2018 period seems like there's some really interesting analogies right now to that period, right? We came into that time thinking about synchronized growth. It didn't quite work out. We had a trade war brewing. U.S. was the best house story. Dollar started to rise. Rates started to rise. What's to prevent that from happening again, Jim, if the dollar weakness has already priced in all this stimulus and our vaccine has given us a big head start?
The biggest difference between today and where we were then was we headed into 18. We had synchronized tightening across the globe. I mean, the Federal Reserve was actively trying to moderate the recovery at that point. Bond yields were headed to 3%. The Fed funds rate was lifting. Money supply was slowing. Fiscal stimulus was being curtailed. So that's a huge difference. We have no policy stop in place of this thing right now. Yes, we're talking about Inflationary pressures may be coming. Yes, we're talking about really hot economic growth, but you have no policy official darn near anywhere in the world that's leaning against that right now. And I think that's the biggest difference. So what we did in 18, to your point, Oliver, is we aborted the synchronized expansion by policy tightening. And there's just no show that we're doing that at all. And as you can see from the chart here that you just put up on the screen, when we get global accelerations in growth, if they're not shut down, the dollar tends to go weak. And I think that's my best guess here again. But as I say, forecasting the dollar could feel like a fool's game over time, let me tell you.
And as you point out in your note with this chart that shows the dollar generally weakening during these periods of worldwide growth, of course, over the last year, we had a little bit of an inverse of that situation where the dollar weakened while the rest, the whole world was getting weak. Jim, I mean, obviously this is a weird period coming out of COVID. I think the case is compelling here, and it does seem that I might be oversimplifying, but it seems like we just always come back to rates, because the point about 2018 where we were tightening through interest rate hikes, we're not doing that today. But we have seen this market throw a fit a few times for bonds when Powell said he's not going to change his QE programs during the press conferences over the last 2 months, in addition to all the economic recovery, of course. And I know people feel very adamantly about this. But to me, still, when we see bonds selling off on days where Powell has said nothing new, right, where he's just staying the course, is it possible that the market kind of could tighten itself if we're not putting any more bonds in? Does the dollar continue to move with yields if we have a breakout higher in yields?
Well, I think that certainly the bond market's going to tighten itself, and I continue to think we'll have yields a little above 2% before the year's out.
Okay.
They'll probably be close to upper 2s to 3 by the end of next year. So we're going to continue to have that, whether the Fed intervenes or not. I think that's going to happen either way. But, you got to kind of put this in perspective, though, too, Oliver, where we're at. We had a 3% 10-year Treasury, or pretty close in January 2018, for example. And we had growth that maybe was 3% in real GDP terms overall. We're talking about rates that are still 170 in the United States and lower abroad. And growth we're looking at that could be 10%. Probably more than 8% real, double digits nominal this year. So, I think the rate situation is so different, not necessarily comparing where rates are now to where they were then, but the growth situation around is just night and day. We could probably handle a 3% yield without much problem this year, given that we're going to have 8 to 10% real GDP growth. So I do think that that's worthy of putting in perspective. I don't think rates are going to stop this economic parade this year, and probably not even the stock market, at least for a while yet, until it takes a bite out of it.
So just want to make sure that I got this. The baseline for the 10-year yield you're thinking continues to move higher, but that we could have a dollar reversal back lower even in such a regime.
Well, and again, if you look back historically, as that chart shows, the weakest periods for the dollar have traditionally been when you have really solid economic growth. Well, what does that mean? During those periods, you're going to find we normally have rising yields most of the time. So I don't think it's anything uncommon that we have rising yields and there could be dollar weakness, because there's several times historically where that's happened.
Okay. So this year's kind of linkage between the two will maybe fade a little bit. What about, Jim, when we think about the drivers of, at least here domestically, the policy which is now shifting from monetary over to fiscal? If we're doing everything we can to juice this thing up in a different way, what does that mean? And does that play a role here as thinking about policy working through the dollar?
Policy, Oliver, is just an unbelievable outlier today. In my 37 years, there's never been anything even remotely close to what we're doing here, not only in the United States, but globally, not only with monetary policy, but fiscal policy. We have just made the decision to run this hot. and so has everyone else in the world. Maybe that's the result of after having almost 2 decades of subpar growth, and our last recovery was barely over 2% per year during that, what we called an economic expansion. We're just going to take a risk at looking at heating it dramatically and seeing if we get good growth back without inflation. I think there's some odds of that happening, by the way. We're going to have a burst of inflation this year, and as the Fed said, and the question will be whether that is just temporary or not, but typically inflation is no good for the U.S. dollar. Whether the worst dollar episode was the 1970s, and rates, as you know, went dramatically higher than they've ever been in the history of the United States, and yet the dollar was a weak currency throughout that period. So a burst of inflation would also be negative for the U.S. dollar.
Okay. Really interesting case, Jim. Really like the analysis here. Before we let you go, though, let's throw the macro traditional stuff aside. Let's talk some Bitcoin. Jim, you're one of my favorite people to talk Bitcoin with, because I think of you, I hope you don't mind this label, as a traditional old school style guy, thinking about the macro forces that we've seen in markets for some time, but now mixing in Bitcoin to your strategy and your view as well, where you've thought about it as a sort of uncorrelated play. I've got a chart that I want to offer to dispute that, Jim. It's the chart of the Russell 3000 valuation, just PE versus Bitcoin. And I don't know, man, these things look kind of similar. What do you think?
Well, I do think that, there does certainly seem to be, some correlation with risk on activity and Bitcoin and risk off. But you could show that same chart with a lot of things, just stocks in general, cyclical stocks, commodities, there are a lot of things. But when you look at the day in and day out, even month in, month out, correlation of Bitcoin to the stock market, it's virtually zero. And it also has that correlation with a lot of other assets we traditionally use in the portfolio. And so I think there is risk diversifying ability of adding a little bit of Bitcoin to your portfolio. But the biggest reason I like Bitcoin, Oliver, is that it's volatility. Mm-hmm. I just cannot think of any other asset that has a volatility that's 4, 5, 6 times greater than the stock market volatility. And if you want to, I think, just add a little bit to the portfolio and then trade it often and frequently, adding on weakness and selling on strength, I think over time you're going to add value, add total return just by being able to exploit this asset with extraordinary volatility. And by the way, the more and more successful that Bitcoin becomes over time, the more it's used by more players, this really interesting aspect of it will go away, because as that market gets more liquid, its volatility is going to diminish, and then it's going to become just another diversifying asset like gold and bonds and other things that have low core to stocks, but it won't have the tradable ability of exploiting the excess volatility.
Okay. Jim, thanks as always. Fun conversation. Appreciate you joining.
Thanks for having me.
Thanks a lot. Jim Paulsen, the Chief Investment Strategist at the Leuthold Group.